Hey everyone, welcome back to The Deep Dive. Hope you're enjoying a relaxed Saturday. Today we are strapping in for what might be the wildest stock story we've seen in a while. We're talking about Oracle, ticker ORCL.
It was more than just wild. It was this violent repricing of debt risk, followed almost immediately by this waves of geopolitical certainty. For anyone in the enterprise tech space, what happened with Oracle this December was, wow, just historic.
Absolutely. And you have to start with the numbers
Yeah.
because they're just staggering. Oracle hit an all-time high, what was it, $328 back in September? But then this panic kicks in and the stock just craters. It hits a low of 177 on December 17th.
Yeah, that's a 45.9% drop. I mean, we're talking about $300 billion in market cap that just evaporated in a few weeks. That's not a market correction. That's the market fundamentally questioning if the company's entire capital structure is viable.
So our mission today is to break that down for you. Why did the market panic so hard after those earnings? Especially when, AI demand is supposed to be going through the roof. And then what exactly caused that huge 5 to 6% pre-market jump just this past Thursday?
It's a story of two massive forces colliding. On one side, you have pure balance sheet risk, debt, cash flow problems. And on the other, you have what we could call sovereign strategic value, the idea that Oracle is becoming a critical U.S. infrastructure.
Yeah.
And that seems to come with a very powerful safety net.
Okay, let's unpack that. Let's start with the crash. It all really kicked off after their Q2 earnings report around December 10th. On paper, it looked mixed, a classic miss and beat, but the beat had this giant asterisk next to it.
It did. The initial disappointment was the top line, revenue. It was $16.06 billion, and that missed expectations. So the core business wasn't growing as fast as people thought it would, which suggested that all this money they're pouring into AI isn't turning into sales fast enough.
But the EPS, the earnings per share number, looked amazing. It was $2.26, which just smashed the 164 estimate. So why didn't that huge beat calm the market down?
Because the big money, the institutional investors, they looked right through it. They questioned the quality of that beat. The whole surprise, that whole beat, it came from a massive $2.7 billion pre-tax gain. And it was a one-time thing, the sale of their stake in Ampere Computing.
So basically a fire sale to make the numbers look good.
Exactly. That one sale added about 91 cents to the EPS. If you take that out, normalize the earnings, the underlying operational profit looks much, much weaker. It was a huge red flag.
Right. It signals they're selling assets to hit their numbers instead of, just growing the business.
And that perfectly sets the stage for the real panic, the CapEx shock and the debt crisis.
Yeah.
This is where things went from slow growth to, is there a liquidity problem here?
This is the main driver of the sell-off, right?
Yeah, absolutely. The primary driver. On the earnings call, management raised their capital expenditure guidance. That's CapEx for fiscal year 2026. They raised it to an eye-watering $50 billion.
$50 billion with a B. And that's a huge jump from what they said last quarter, which was $35 billion. So a $15 billion increase overnight.
It's a colossal bet on winning the AI race, basically trying to outbuild Microsoft and Amazon. But the immediate financial impact of that announcement, it terrified the market. It pushed their free cash flow deep into negative territory.
Okay, just a quick reminder for everyone. Free cash flow is the cash a company has left over after it pays for everything it needs to operate and expand. It's what you use for dividends, buybacks, paying down debt.
And Oracle's was negative $10 billion for the quarter. That's $10 billion lost after accounting for their investments. The market saw a furnace just burning cash. Now you combine negative $10 billion in FCF with a debt load that's already at $105 billion.
You can see why people panicked.
Exactly. It completely changes the story. Suddenly, Oracle isn't an AI leader, it's a credit risk. We saw their bonds start trading at levels you'd normally see with junk bonds, even though they technically have an investment grade rating. The market was basically saying, we don't believe you can fund this $50 billion plan without serious trouble.
And that vulnerability was just brutally exposed. That's what led to the stock hitting its absolute bottom on December 17th, the Blue Owl incident.
Right. The Financial Times reported that Blue Owl Capital, which was a key financing partner, was pulling out of a deal, a $10 billion data center project in Michigan.
That seems like a business detail, but why did that one report crater the stock so fast?
Because it exposed the weakness in their whole expansion plan. Oracle needs third-party capital. They need firms like Blue Owl to pay for the data center so they don't bankrupt themselves. So when a smart money player like Blue Owl walks away, it sends a signal that the risk is too high or the terms are bad. It made it look like their whole AI build-out was about to stall.
Now, we should be clear. Oracle did officially deny that FT report. They said they had another partner, but the damage was already done. The confidence was shot. And then the Wall Street analysts just piled on.
They did. You saw JP Morgan cut its target to 230, Piper Sandler down to 290, DA Davidson went all the way to 180. The narrative was set, it was simple, and it was brutal. The financial risk was just too big. It was outweighing any AI opportunity.
If you like what you're hearing today, we invite you to subscribe, leave a like, and tell us in the comments what topics you'd like us to tackle next. In the description of this deep dive, you'll find two important links. One to our sponsor, Broker360, and another to PayPal if you want to support this project. Your contribution helps us a lot to keep making content like this. We only ask for the cost of a coffee. Thank you for your support. So it really sounds like Oracle was dead in the water, a classic credit risk story. How in the world do you go from that, from trading near junk levels, to this massive geopolitical win and a huge rebound almost overnight?
It was a perfect storm, really. A perfect storm of regulatory certainty and strategic necessity all coming together in just 48 hours. The turnaround was fueled entirely by Oracle, confirming its role as an essential tech partner for the U.S. government.
And the big one, the headline that really drove that rebound, was the TikTok deal finally getting done.
Precisely. The reports confirm that the binding agreements were all signed, finalizing the structure of this thing called the TikTok USDS joint venture. And this new company, this new structure, it just massively de-risks Oracle's future.
So let's look at that structure. The new entity is mostly owned by a U.S.-led group, but what does Oracle get out of it specifically?
So Oracle gets a direct 15% ownership stake. But the key thing, the most important part, is that Oracle is named the official trusted security partner. This means they aren't just a vendor selling cloud services. They are the government's chosen guardian of the platform's security.
That completely flips the script. Before, TikTok was this huge regulatory risk that could get banned any day. And a ban would mean zero revenue for Oracle. Now it's a secure, high-margin contract.
That's the key. Oracle is now the custodian. They're going to host all the data for 170 million U.S. TikTok users on their cloud. They'll also supervise the algorithm to prevent foreign manipulation. This locks in a huge, stable customer for them.
A huge win. But the government support didn't just stop with a consumer app. You called it a seal of approval.
No, it went much bigger. It escalated right into national security. On December 18th, Oracle announced a collaboration with the Department of Energy. It's for something called the Genesis mission for national AI projects.
And this wasn't just some press release. We saw Oracle execs at the White House for this. This was sending a very clear message that Oracle's infrastructure is now seen as critical. Critical for science, for national security supercomputers.
That implicit government backing does wonders for a company's risk profile. It turns Oracle from just another cloud company into a strategic asset. It guarantees long-term government contracts, no matter what the free cash flow looks like this quarter. It's the government signaling that Oracle is too important to fail.
And as if that wasn't enough, you had this supporting news come out about their biggest customer, OpenAI.
Exactly. The rumors that OpenAI is trying to raise $100 billion at just a gargantuan $750 billion valuation. And that rumor is so important for Oracle's debt situation.
Because Oracle has that massive $300 billion contract to be their infrastructure partner.
Precisely. The market was worried Oracle was building all these expensive data centers for a customer that might not be able to pay its bills someday. That's counterparty risk. But news of this huge cash infusion for OpenAI, it guarantees that Oracle has a solvent customer to pay for that $50 billion CapEx plan. It took a big piece of risk off the table.
Okay, so let's synthesize this. The government isn't just a customer anymore. It's almost an implicit partner. Just how deep does this integration go? I mean, are we talking about Oracle becoming part of the federal plumbing?
It really is. It's been institutionalized through the General Services Administration, the GSA, using this model called OneGov. It's a strategy to standardize and streamline how the entire federal government buys technology.
And Oracle's been a big part of that. What kind of benefits do they get that, say, an Amazon or a Microsoft doesn't?
Well, the agreement they signed in mid-2025 is massive. It gives federal agencies a 75% discount on software licenses and big discounts on their cloud. But here's the real kicker, the key differentiator. Oracle offers price parity. The prices is the same for their commercial cloud and their high security, secret, and top secret government clouds.
Wait, really? They don't charge more for the most secure classified environments?
They do not. And for the Department of Defense, that is a complete game changer. It's why Oracle is a central player in that huge JWCC, the Joint Warfighting Cloud Capability contract. They operate the kinds of data centers needed to handle top secret data for DISA impact levels 5 and 6. They've built themselves into the core of the defense and intelligence community.
So let's bring it all together. The collapse and the rebound. Let's separate the hard facts from the market's interpretation.
Okay, the facts are, financially, they're pretty ugly. But geopolitically, they're very secure. Fact, free cash flow is negative $10 billion. Fact, total debt is $105 billion. But also, fact, Oracle is now the legal security guardian for TikTok. And fact, it is now a confirmed critical partner for the Department of Energy and the DoD.
And the interpretation of those facts is what sent the stock from 177 back toward 200 in just 2 days.
Exactly. The interpretation driving the crash was all about bad earnings and fear about their liquidity. The debt was just too scary. The interpretation driving the rebound was that the U.S. government now views Oracle as a strategic asset, that it provides a safety net that is more powerful than the weak balance sheet. It's the government telling the market, we will make sure they have the business they need to succeed.
And you can see that so clearly when you look at how Oracle's peers did during that same period.
Right. The peer comparison proves this was an Oracle-specific crisis. It wasn't about the whole tech sector. While Oracle was down over 18%, Microsoft was up 1.7%, Amazon up 2.5%, Alphabet up almost 2%. The market was fine with the AI story in general. It was just punishing Oracle's balance sheet. The rebound shows the government basically bailed out the narrative.
So this whole crazy episode, this extreme volatility, was a direct result of that clash. A clash between huge financial risk, that $50 billion in capex, the $105 billion in debt, and this incredible geopolitical resilience.
It really confirms that when you operate at this intersection of AI and national security, government support can create a floor under your stock price. It's a level of strategic safety that you just can't see by looking at a traditional financial statement.
Which leaves us with a really interesting, maybe provocative thought for you to think about. The government has effectively declared Oracle a necessary part of America's technological sovereignty. But that $50 billion capex bill still has to be paid. That $105 billion debt is still on the books.
And that's the real question investors are wrestling with now. Does that national security value truly trump the debt? Or is the government just buying Oracle time until that enormous $500 billion contract backlog they have actually starts turning into real hard cash?
And with that, we reach the end of today's deep dive. We hope you enjoyed it, learned something new, and that you'll join us next time. Once again, a big thank you to Broker 360 for making this deep dive possible. We'll meet again very soon. Remember that the links to our sponsor and PayPal are in the description if you'd like to support us. Thank you once more.